You're live.
We're live. All right, good deal. My name is John Hinks, and welcome to the COVID-19 mortgage guidance webinar, seminar, whatever you want to call it, guys. This has been put together pretty darn fast for us to try to help our real estate agents, our builders, and so forth navigate through this crazy crisis that we're in. And first off, I want to thank the Mortgage Marketing Animals for helping us put this presentation together by using their technology, because I think between the five of us, when we started talking about live webinars and Zoom, we were all kind of we need help. So here we are. So I want to go ahead and take the opportunity to just go ahead and let the five panelists introduce themselves. I'll start off real quick. My name is John Hinks Jr. My family's been in the mortgage business since 1983. I personally have been in it since 2003. I have seen the broker side. I have seen the correspondent lender side. I am a producing branch manager for Lending Path Mortgage. And I've been very blessed to have colleagues and actually, honestly, guys, competitors in my business, that we have a very good friendship, that we are able to help each other through this crisis, but more importantly, be able to help the real estate agents. So I kind of want to take the moment for everybody to be able to introduce themselves. So Brian Prahl, you're next on my screen, buddy, and you're going down the line. So if you'll take the opportunity to introduce yourself, that'd be great.
Yeah, absolutely. And thank you, John, for putting this together. This is a huge value add for the people that are watching, so I'm glad to be a part of it. But again, my name is Brian Prahl. My title is Regional President. I am a non-producing manager of a company locally that we brand as called the Palmetto Mortgage Group, and we are a division of a national lender called Lend US. Been in the business since 2003, and kind of like John, seen all sides of the business, and so that's where we are today.
And James Fleschman.
Yes, I'm James Fleschman. I'm the founder and owner of Foundation Mortgage, local mortgage brokerage firm here in Columbia. I've been doing mortgages in a couple block radius here since about 1991. So I have enjoyed doing that. I started Foundation Mortgage in 2001. So I do originate loans, but we've also got other originators here in the office as well, and support staff right here in downtown Columbia. And as you guys have said already, seen a lot of changes, but it's been a great industry to be in, and we want to continue to support the real estate community, because they have supported us and been able to enable us to have a great profession and be able to support our families and really help the home buyers of South Carolina.
Absolutely, man. James, you've been around for a while, man. So he's seen it all, guys. He's seen it all. Clint Hammond.
Yeah, I'm Clint Hammond, producing branch manager for Mortgage Network here in Columbia. Like John and Brian, I've been in the business since 2003. I've been with Mortgage Network since 2003. So I've pretty much been here for my entire career in the mortgage business, but that's been a heck of a career, especially with what we've seen over those years. But just glad that we're able to be here, and hopefully we can add some value. John, I appreciate you reaching out and putting this thing together for us.
Oh, my pleasure, Clint. Thanks for participating, man.
Absolutely.
Nathan Ballentine.
Hey, I'm Nathan Ballentine. I am a market leader here with Movement Mortgage. I've been around for a while. I've been in the financial industry for 20 plus years, doing mortgages since 2000. Was at a big bank for 20 plus years, made a move over to Movement about 5 years ago, and just grateful to be with a group of colleagues here that I respect. And let's get everybody through this extraordinary times. Let's talk about how the industry is going to go. And most importantly, one thing we ought to all be blessed for is we are essential to the economy. And I think America's counting on us. So that's a good place for us to be right now.
Hey, we're going to touch on that, Nathan. Thank you so much for being here, man. Really, that's a huge part. We are a huge, essential part of this economy. So Ryan, I would like for you to introduce yourself as well, please.
Hi, I'm Ryan Hayes with Mortgage Network, Senior Vice President of Residential Lending. I'm probably the only one that you haven't seen at a real estate mixer in Columbia, South Carolina. I'm based up here just outside of Boston. Been doing this for 20 plus years, started on the origination side, but my focus is really on operations and secondary. So hopefully we'll be able to answer some of those questions about why we're seeing what we are seeing in the market. I always say being in the real estate business is a great natural hedge to whatever's going on in the world. So we have pandemics. We should be doing pretty well in our universe here. So hopefully we can help guide you through some of these choppy times, but it should be a good year for all of us.
Man, thank you so much for being here, man. I know you have got your phone probably blowing off of the hook right now with loan officers in your company, and for you to take the time to be here with us. Thank you. So because of that circumstance, let's jump right on in it, guys. I'm gonna try to help guide us through this so that we don't talk in a tangent and get these real estate agents some very, very valuable information so that they can better educate their clients so that we can move forward. I've kind of got this little thing broken down. We're going to do some questions and answering from some agents that have already submitted some questions, and hopefully we'll get some as we go. But I kind of want to just start off. What the hell just happened the last 3 weeks, guys? You know, I feel like the dust is still in the air. It's starting to settle a little bit. And I think we just turned in about 3 months of economic disaster in about 2 weeks. And as far as what we're facing, that's the only way I can kind of face it. The stack of cards, the bottom card was pulled. And I don't want to say we're all crumbling down, but I'm telling you, we're hanging on by a card or two. And I'm going to stay positive through this whole thing, but I think it's very important for us to communicate the fragility of our market. Can someone, you know, kind of elaborate a little bit about what they've seen the last 3 weeks, you know, as far as what they faced?
Yeah, I mean, I'll jump in. Really, if you go back to 8 months, we've been in an environment where rates have been coming down consistently. That kind of accelerated there towards the end of February. Really came to a head the end of that first week of March. We had the most ill-timed company trip. So Ryan and I were actually together when things really went ballistic. But you had extreme volatility in the. It was, oh God, you could have held a gun to my head and I couldn't have told you what rates were going to look like the next day. And you're mad scramble to take care of those that you've already spoken to, and you're looking at the refinances and trying to take care of your purchases, et cetera. And then really, I guess what mid-March is when the federal government stepped in and started at least trying to stabilize things. And so we saw some pricing stability, but as the COVID-19 really started to set in, and you started seeing the shelter in place stuff, and you started seeing more uncertainty from a bigger picture, not just our world, but the bigger picture, that's when things got real hairy, real quick.
And what does the hair kind of look like right now? I mean, are we, you know, I tell you on a personal standpoint, I can remember a Sunday night listening to a very esteemed colleague in our business, Barry Aviv, say, hey, mortgage-backed securities are about to get pumped. And that was 2 or 3 Sundays ago. And I remember licking my chops going, oh my gosh, here comes the refi market. And sure enough, the next day, no changes. Tuesday, the next day, no changes. It kind of, like you said, there would be a window of 4 or 5 hours where the rates would actually settle down and everybody locked like wildfire. So Ryan Hayes, when everybody locked like wildfire, what did that mean for our industry?
Well, there was, for the first time really since 2008, a real decoupling from what the treasury market was doing and what mortgage-backed securities markets were doing. So, you know, in general, right, stocks up, bonds down, bonds up, stocks down, these things kind of flow in tandem with each other. We started really seeing divergent paths for mortgage-backed securities away from the treasury. Meaning, you know, even today, right now at a treasury of, you know, where a 10 years at 67 basis points, the corresponding mortgage rates you would think should be in the 2s based upon our history, and they're just not really there right now. We have a number of different issues that are going on sort of in the background, whether it's liquidity from the buyers. We saw the uncertainty of COVID drive all of these corporations to start selling bonds and move into cash. That was a big piece. And we really didn't see any stabilization between that 10-year treasury spread and the mortgage-backed security spread until the government stepped in and started buying mortgage-backed securities again. It took them a little while to sort of find the right pace to buy mortgages, and they're still kind of trying to do that now. But it really wasn't until they did that where we started to see really any stability, and we've just started really to see that stability over the last week. The other thing that everyone is facing is capacity issues. So everybody on here has processors and underwriters and closers that all have pipelines, and we weren't even into the purchase market yet, really seasonally. So the different levers of the market kind of being all over the place, it became very hard on the secondary side to even decide what rates to put out. And then on the capacity side, just trying to make sure make sure that everyone we're going to meet our disclosure requirements. We're going to be able to still underwrite and meet our contingency dates. So it was very important for all of our companies on this call to make sure that we could handle all of that pipeline coming in, which is why you've seen some instability in rates.
So in a grand scheme, agents that are listening to this, to try to get it a little bit, the way I can understand it is, when you lock an interest rate, you're actually locking with real money. Okay, you're guaranteeing a rate to be available from 30 days from now, no matter what happens to the marketplace. So it's a gamble. Okay, so this money is tied up. This money is promised. Would everybody agree with that?
Yep.
Okay, so when you have these interest rates that just go straight down, all this money gets tied up, all this money is promised, and then Nathan, a week later, the government comes out, or the Fed comes out and says unemployment went from what to what? What happened there?
So unemployment spiked. I mean, people were predicting that it would be $2 million in jobless claims, and actually it was $3 million. So it was even worse than anticipated, and that's the thing that is so unnerving for everybody out there, for the realtors, for those wanting to sell, those wanting to buy, and of course us in the finance side of thing, is nobody knows when this thing is going to end. We're going to continue to see a lot of changes, not just in America and in South Carolina, but in the real estate industry. The good news is all of us that are on this call today have been through it before. Many people that have dialed in, if they've been in real estate for a while, have been through it before. So we will all get through it, but we just need to talk about it so that everybody has the proper expectations of how they're going to get that home sold in what amount of time, who's going to be buying it, what programs will be out there when the time comes. And so that is what we're focused on. And unfortunately, what the media is focused on, and I hate to bash them, and I don't mean to do that, but they're talking about the downside that we all see is unemployment, the economy, businesses shut down, states shut down. The word right now, y'all know, is default. And maybe Ryan can tell us, and Clint can get into more about this. We talked earlier, people think that most people think getting a mortgage is like just going into a grocery store and I'm going to go grab a mortgage off the shelf and I'm going to head on home. Well, it's not like that. You've got investors, you've got hedging that you talked about, you've got promises, things like that. I jokingly and realistically tell people now, look, go in the grocery store and try to find toilet paper. It's different than it used to be. Everybody go in there and get toilet paper. Now you're looking for 2-ply, but guess what? 2-ply is not there. It's all right. You'll live. We'll go 1-ply. And so I don't know if Ryan wants to talk about that, but I mean, there's a lot involved in getting a mortgage on the back end. I mean, the realtors have to bust their butt so much to market houses and find buyers and drive them around town. And that's something I know we'll get to later. That's changed now. But Ryan, John, you want to get in and talk about how a mortgage works?
And this is kind of what Ryan can touch on. I'm going to try to keep it dummied down just a little bit. But here we are. We locked all this money. We have billions in dollars of promised interest rates to people that want to refinance and people want to purchase. In 1 week, we go from a 3% unemployment rate to a 10% unemployment rate. And then it seems like the perfect storm is happening. And the perfect storm did happen because, the country's on lockdown. Everybody's staying home. Nobody can work. And the house of cards are falling from one way. We got unemployment over here and it's going down here. And then we have you know, all this money that's been promised. Ryan, what's happening with everyone right now that that's happening?
Yeah, so, you know, this is driving sort of some of those headlines in some of what you're hearing out there for lenders that are starting to restrict based on credit characteristics, raising minimum FICOs, DTI, lowering DTI thresholds. You know, mortgages are sold, right? We have an owner of the mortgage and then we have an owner of the servicing. And that servicing, we get paid for on the asset side. We use a hedge to make sure that if the market goes up or down on the interest rates, that we're covered when we have a loan that comes in. Mortgage servicing rights generally is a pretty static number. It's based upon the future cash flows of mortgages coming in. And what has happened is that we saw two things at one time, which is we saw a massive increase in prepayment speeds, which drives the value of servicing down. And then we saw a massive increase in what's going to be perceived defaults, which again drives servicing values down. Where we used to be able to count on, you know, 100 basis points or 1% of a loan to be paid to us in servicing, now on some of that lower FICO FHA business, we have to actually pay a servicer up to 2% of the loan amount to just take that loan off of our hands.
And who does that get passed to? The buyer, correct?
Exactly. And where that really ends up is in two things. One is the premiums aren't high enough to even really offer those types of programs. So we're starting to see, you know, even lenders that are out there that have, you know, 620 still available in FICO, your borrower or your buyer would have to pay 3 or 4 points just to get that rate. So we're starting to see these things really start to trickle through to rate sheet prices, which is going to affect, you know, the purchase market and what borrowers can actually or buyers can actually afford.
Hold 1 second. I just got told, I think we got cut off real quick. Let me see. Not sure. It says we're still recording. I'm not sure if we got cut off or not. But anyway, we'll just keep moving forward. Brian, Prahl, you saw that last week, man. You saw promised loans, and I saw it too, guys. Oh, okay. Someone named Conley says we're still good. Okay, thanks, guys. My company saw it too. We saw promised loans that were under contract, and all of a sudden our credit score requirements changed in midair, and we could not honor loans that were under contract. We could not do it. If we had honored them, what it would have done to our company as a whole would have hurt Lending Path, or I'm a subsidiary of a company called Success Mortgage Partners, and it would have, I don't think the word hurt is enough, but let's just say hurt. And some companies are in different cash positions than other companies. And of course, the rumors would go out that we were not liquid, we were not able to fund. But what was promised and what could have been delivered were two totally different things. So I had a hard week last week, a really hard week. I had a baby on Thursday, and then on Friday I had 15 phone calls I had to make that were just some of the worst phone calls I've had to make in a long time. Brian, I mean, kind of share, I mean, we're similar a little bit as far as the company is concerned and how we operate. What kind of experiences did you see that happened last week in our industry, just from a branch manager standpoint?
Yeah, I mean, you saw a market shift immediately where companies were getting hit with what's called margin calls. And Ryan can probably explain that much better and easier than I could. But so you had a position where companies didn't have buyers for their loans that were under whatever credit score they deemed appropriate. So, you know, we immediately went to a 660 credit score, ended up backing that down into the 640 range. And now you're seeing a lot of other companies, most companies will end up being somewhere in that range at some point very soon. So, you know, we took the approach of, all right, let's go in order of closing date. If we can flip this from what's called a mandatory lock to a best efforts lock, we did it and we funded with no issues. For the sub 600 loans, we did have a couple of problems. And so luckily for us, we were able to try to flip those to other local lenders that at the time still had those loans available. And I think last I checked, we had, 7 or 8 loans that were affected, and all 7 or 8 are going to be able to purchase a home at this point. So it was tough conversations to have, but like everybody on the call, if you get faced with that type of situation, I mean, you're looking out for the consumer first, you're looking out for the realtor second, and then you're looking out for your loan officer third. And so that's the order of priority that we took. And as a result, we were, like most everybody, I'm assuming, we're able to salvage most of those transactions for the consumers.
That's great. And I commend a lot of the people in our industry, especially in Columbia, where we called and we said, we need a home for this loan. And unfortunately, Friday morning, we got a home, and then Friday afternoon, they would call back and say, we no longer have a home. So it changed that fast. I think I know I was a little bit ahead of the curve when it came to having to make announcements or getting the news. My leaders kept telling me, everybody else will follow suit eventually. But that's my side as a correspondent lender. James Fleschman, you're a broker. So you have a plethora of lenders to choose from. What did you see?
Well, even though we do have a tremendous number of opportunities for us to deliver these loans, like we're talking about in this group, it's pretty much across the board. You're seeing these type adjustments having to be made to be able to deliver loans into the secondary market. So yes, at times we may have product that somebody else says they don't, but if it's in those low score buckets, it's only a number of days until that goes away. So that's not something that I would necessarily be out marketing, that I can still do it today, but it may go away tomorrow. And here's, I think, one key point to think about. The biggest adjustment that we're seeing are in what we all call the Ginnie Mae pool, but that's what everybody else calls FHA and VA. And that's where you're seeing most of these adjustments that are occurring, where you're seeing most of the credit score adjustments, the debt to income ratio adjustments. The Fannie Mae, Freddie Mac side, you're seeing less volatility on those rules. At least that's what I'm seeing. And so we're able to have some stability there. So that to me is a positive. The volatility of the rates is across the board for government and conventional. And I don't want to take up too much of my time, but one thing that I thought would be a kind of a rubber meets the road, where real estate agents could benefit from understanding what this means when we're talking about the way the volatile rates are, and that you cannot get premium pricing, what we might call up the ladder of rate. So before, you would say, hey, the seller is going to pay some of the costs, but not all of them. Can you kick in a credit? What you're seeing right now is, as you go up the ladder of rate, you're not seeing a premium that any of us can throw into the mix. Most all of the clients that we're locking in are paying some form of a discount point in all likelihood, because they're able to buy such a great rate for that discount, but we can't go up the ladder of rates to get a credit. What this means to a realtor is, it's now more than ever, if your client needs help with those closing costs, you need to negotiate those into the contract so that the seller is paying those transaction costs. So page 2 of the CCRA contract, where it's talking about those transaction costs, we need the seller to pay those. The lender doesn't have the ability to kick in that credit. At least that's what I'm seeing. I think you guys may have some opinion about that. But that is some of the thought that I'm having as we pivot around what issues exist. Maybe we go from a heavier FHA, maybe looking more and more to conventional type financing.
James, I think you hit the nail on the head there, man, with the premium pricing. And as that pertains to realtors, I think we witnessed the shift from an inventory short seller's market over the last several years to, in the next several months, couple months, you're going to see that transition into a buyer's market, and sellers are going to be almost required to pay closing costs for any government borrower that they're going to accept a contract on. I think that's a switch that we saw happen pretty much on a dime last Thursday.
And the bottom line, realtors, if you're listening to this, the bottom line is the Govy market right now does not want to be touched. It's a risk factor, but there's good reason for it to be a risk factor. I mean, if you have a sub 40 credit score, that's what we're calling right now in our industry the new 2020 subprime loan. A month and a half ago or 2 months ago, these loans performed. These loans performed, and they were good loans, and we were able to get people into a home with these loans because the unemployment rate was 3%. We just went up on the unemployment rate on the last numbers, which was a week ago, by 500%, and it's rising. It is rising right now. And that kind of goes to a little bit something that Clint and I kind of talked about, is the fiduciary responsibility of a loan officer. Well, our job, Clint, just take that part of it. You said it best, you know.
Well, I mean, and maybe I'm too idealistic sometimes, or you know, almost look at it in some utopian type of a way. But I've always viewed myself in my position and my responsibility, not just to get a loan approved for somebody. I've always wanted to make sure that I was setting that individual up for success, regardless of what the situation was. So, you know, part of my application conversation, so to speak, is, you know, forget about what I can get approved. What are you comfortable with? And we can be talking about monthly payment, or we can be talking about down payment, or you know, whatever aspect of the game plan or strategy that we're talking about at the time. And that's because I'm not worried at that point about what are the guidelines, or what is the pricing, or what is going on in the secondary market, or is it a risk averse environment in the lending world. But it's, you know, what do you and your wife feel like is a comfortable place for you to be buying this home? Whether it's, you know, like I said, on the monthly payment side is usually where that gets into the meat of it. And it always comes down to the hopes and dreams and fears and doubts conversation, where you're digging into, you know, do I feel confident and comfortable that my job is going to be sustained, and that I'm going to be employed 6 months down the road, or a year down the road? Or, you know, am I very upbeat with the thought process that I'm next in line for some promotion, and that, you know, wife's not working now, but as soon as the kids are in daycare, she's going back, and we're going to have more cash flow, et cetera. Well, that conversation has dramatically shifted in the last 2-3 weeks. And it's, you know, I'm not real sure whether or not I'm going to have a job next month, or I'm not real sure what payment I'm comfortable with, because I don't know that my income is going to be the same in April and May as it was in February and March. And so, you know, I feel and I always have, I feel a responsibility not just to get the loan approved and funded. That to me is secondary. The primary objective is to put somebody in a situation where they can be successful, because, you know, I always joke and say, you know, I got to make sure I do right by you, because I want to make sure that I'm the one writing the mortgage when, you know, you buy that $750,000 beach house, you know. So, but that's part of what I feel very real is my responsibility. And John, it's like when we were talking Saturday, you know, I got that same sense from you that this is about making sure that we're taking care of somebody. Because I think maybe the biggest fear for 17 years of doing this, what makes my stomach turn over, is the thought that I wrote a mortgage for somebody who then lost that house. And that has nothing to do with the health and financial well-being of Mortgage Network, or the secondary market, or who's buying what loans, or what's the risk tolerance, or, you know, QM, non-QM. Not all that's out the window. The reality is, I don't ever want to feel as if I am responsible for somebody and the financial devastation that comes with not being able to make that next mortgage payment. And that's, so you're trying to marry up two things that sometimes are just enough out of line or out of whack that it can make the job a little more difficult. But at the end of the day, all of this that we're dealing with, and, you know, as Nathan said earlier, we've those of us that have been in the industry for a long time, we've dealt with this in one way, shape, or form. Most notably, 2008. It doesn't change my process with the borrower. It doesn't change the fact that I'm going to put a financial strategy together for somebody, so that when we go out looking for a house, we can buy the house, we can get approved, and that we walk away from the closing table comfortable and where we need to be. So this just changes some of the rules on the rules of the game, so to speak, but it doesn't change my approach. And based off of my conversations with all the guys on this call, it doesn't change your approach either. You're still going to do what you do the way that you do it, to make sure that you're doing exactly what your charge is, and that's to take care of the individual who you're sitting across the table from.
And Clint, you said it the other day, and I think it was you, just because you're a direct seller servicer, or whoever out there is saying that they're a direct seller servicer and they have the ability to write 580 mortgages,
Right.
doesn't mean that it's a sound business decision to do it or the
That's right.
for the consumer.
And it doesn't mean that it's right for that person.
Well, and this is a great point right here, and Ryan can help me with this because I watched The Big Short last night again.
I watched Margin Call 2 nights ago.
And
A classic.
Ryan, let's talk about the grander scale of things, and Nathan can help me out with this. And I'm just going to ask this question: we write a bad loan. We know the loan may not perform, but we're going to make sure that the agent gets their commission and we get our commission and so forth. And the loan's done, said and done. Let's just say that happens, okay? And let's say everybody is just still doing that, business as usual. Besides the borrower that will lose the house and not buy another house for another 7 years, Ryan, who else gets affected in the grand overall economic standpoint? What are these mortgage-backed securities funded by? Is it some billionaire off the coast of Florida smoking a big cigar? Who is it?
I feel like this is a tremendous, incredible leading question, which is, right, it hurts everyone because everybody's 401ks, everybody's pension plans, regular Main Street retirement are invested in mortgage-backed securities. Most people don't realize that the U.S. mortgage-backed security market is the second biggest bond market in the world. The Treasury market is first, and the U.S. mortgage market is second, bigger than any other country's sovereign debt. So there are a lot of investors inside of mortgage-backed securities, and it touches everybody. So when, everyone down from the servicer to the lender to the borrower, these things have a lot of big financial implications throughout the market. One of the things that all of you guys have touched on, which is sometimes you don't get this everywhere. So it's refreshing. Maybe it's just this little pocket of Columbia, South Carolina, but it's refreshing to hear loan officers talk about fiduciary responsibility and making sure that you're doing right by the client, because, we all know people in this industry who don't necessarily have that same mentality, right? And this kind of goes along with some of the things that realtors you may have been hearing about, which is Fannie and Freddie has given us some guidance on loosening of some guidelines during COVID-19 to provide for some alternative documentation and things like that, where, VOEs may not be able to come from a company in a typical way because they're closed, their office is closed. Fannie and Freddie has put the caveat back onto the lenders to say, look, we understand that we will take this documentation, but we want you to do your due diligence. And this goes to something Clint was saying earlier, which is somebody who's furloughed right now, who may be expecting to go back and is in the middle of a transaction, really needs to think about, when will they get back to that job? Because the worst thing, like you said, that can happen is for somebody to get into a house and be in trouble right off the bat, right? I mean, it's bad enough that people are in houses for 5 years and hit an economic downturn, but talking about putting yourself behind the 8 ball right in your first payment, right? So you want to make sure that, your borrowers right off the bat, even if there are some relief from some of this documentation, that you're doing that due diligence and asking those questions, because they're gonna look at you as the realtor, they're gonna look at you as the originator when they all of a sudden can't make that first payment and they say, oh, I thought I'd be back to work by now, right? And I've been reading on the news that there's some leniency. Well, that only goes for certain transactions. It only goes so far. So, same thing with the government aid packages, right? We know that there's going to be some type of government aid package to consumers. When and what that looks like is kind of anybody's guess. So, I think all of those things are in play, and you guys are doing a good job of talking to the realtors and talking amongst yourselves about, these real questions that we've got to ask ourselves.
So let's talk about those questions, if you don't mind, because I think now that we've kind of set the stage for the last 30 minutes, I think we've all kind of understand. We're explaining that this all happened very fast. We're all still trying to figure out, the theory as to it was a perfect storm. The government pumped money into the mortgage-backed securities. The unemployment rate went up. And then there was a stimulus package that said you could forgive your payments for 4 months. And the servicer said, we don't want anything to do with that. So therefore, we're not going to fund government loans. But if you want a government loan, it's going to cost you X amount of money. And then this happened, and then this happened, and this happened. Now, Tuesday, March 31st, 2020, we feel that we've kind of got a little bit of a grasp of what we can do moving forward. Some people, other lenders, are still, in a wheelhouse that we may not be in. I mean, the 5 of us are probably in different wheelhouses, but there are some questions. So this is to help equip the real estate agent and give them the answers that they need. And unless anybody else has kind of something they want to kind of talk about, from here on out on this meeting, I want to be able to better equip the real estate agent now that they know what has happened, and they can explain it to their borrowers that we're either under contract or about to go under contract. Let's talk about what we can do from here on out and what we're able to help the realtor with. And the first question that I have came from, let's see here, it came from Kim Brooks. Will FHA, VA, USDA loans be almost impossible to get for a period of time? Almost impossible or whatever. So who wants to, Brian, why don't you talk about what you can do right now, FHA, VA, USDA?
Yeah, I mean, sub 620, the answer to that is yes. It's going to be tough for those borrowers to get into homes right now. Even if a lender is currently saying they can do it, the likelihood of those guidelines existing in 3 weeks are going to be tough. It's minimal. Over 660, 680, 640, whatever the mortgage company that you're dealing with guideline is. No, I mean, there's going to be some tightening guidelines. You'll see debt to income ratio restrictions be put in place, like Ryan mentioned. You'll see, some people with some credit score minimums and things like that. But if the borrower remains employed and qualifies otherwise, I don't think it's going to be, to use your quote, nearly impossible. I think it'll be something that we can get done as an industry moving forward.
Anybody else want to chime in?
Yeah,
I would say that anybody who working with one of the lenders that's still paper or stated guideline is down to the 580 like we were 2 weeks ago. You want to be vigilant there, because as it happened to all of us on this call, that can be something that overnight changes. And so if you got somebody in process, you might have just want to stay on top of it, I guess is what I'm saying. Just keep a close eye on any transactions you've got under contract in process. If you know that there's a lower FICO involved, it could go away tomorrow, and that can be swift, as John found out last week.
John, let me add to that. And y'all thought I might have been joking when I said America's counting on us, but they are counting on us to keep and get this economy back to where it was.
That's not a joke, Nathan. You're right. Keep going. I'm sorry to interrupt you. That's not a joke. That's the real thing.
And the thing is, we've all hit on it, is we've got to do it the right way. What you're seeing as agents out there is you're seeing lenders that are good corporate citizens are making the hard decisions. And frankly, they're just being responsible. Not only, obviously, they want to take care of their employees and they want to take care of the financial markets and make sure that they don't close shop, because you have seen that in other parts of the country where some are unfortunately going to have to close shop. But what you want to do, as you've heard, is there's going to be overlays, and none of us on this call like overlays. But let's go back to 2008, and I'm going to bring up something I'm sure we all remember. Back in the day, I could do 100% financing, interest only, up to $750,000 on an ARM, and it was almost like it was stated income. That's not responsible lending, And so I tell people, back then, that's what caused the financial crisis. Right now, we're here as the knight riding in to save everything. We didn't cause this. This was a virus. This was a pandemic. But we have got to make sure, as Clint, you just mentioned, and Brian, make sure that the person that is going to get the house, nobody knows their future, but make sure they're on stable ground with their job first and foremost. And the other thing is, do they have any kind of reserves? Y'all, we're a paycheck to paycheck society, whether you're a doctor or whether you're a bartender. That's just how a lot of people are. And the days of somebody who's been late 90 days or 60 days or 30 days on a mortgage or something like that with no reserves, as much as you as an agent want to help them get that home that they think they desperately need, you don't want to be the person, like Clint mentioned, that they come back to in 3 months or in a year. And, they thought they'd have some program that would pay their mortgage, and that turned out not to be true. And now they've got the stress at home. And I don't even want to get into all that stuff with the depression or domestic.
It snowballs. It snowballs.
And you don't want to be associated with that. So I share all that to say, you know, the number's going to change, 640, 660, 680, whatever the case may be. Brian hit it on the head. Below 620, there's a reason that score's below 620, and be careful. You as an agent just need to do like we're doing and be completely transparent and upfront with the individuals and let them know. I know it's hard, and I know this sounds like I've never said this before, but there's borrowers that I've had a conversation that said, I just really want you to think and see if this is what you need to be doing. And you want to do the right thing and be responsible, because if we don't do it, we're going to stay in this mess and the economy's not going to get back.
So the next question comes from Tara Johns with Resource Realty. If we get someone approved and under contract in the next few weeks, are those loans in danger of not closing or having funding pulled while under contract? This is for new business only. Everybody's quiet on that one.
Well,
Yeah.
there's danger. You know, if it's somebody, if it's a 615 with a lender that currently can go down, but then maybe their guides change, you'd have an issue. But maybe she's referring more to just in general. And, you know, I'll knock on wood now, like I have every other time I've said it when I've been asked the question by borrowers. The one thing that I can't guarantee is, you know, are we going to run into a situation where somebody doesn't want to let the appraiser in their house, or the appraiser refuses to go in the house, or doesn't accept the order, or you know, are there delays with title work? You know, things that are sort of outside of our control on the origination side. You know, there's certain people we have to rely on to do their piece. I guess there's always a possibility that you hit a snag in one of those areas. The other very real concern is the borrower that's been furloughed, or I've spoken to 7 or 8 people just in the last week that were either in a position of managing others, or were business owners themselves. And, you know, the discussion with them was they were hanging on as long as they could, but then at some point had to have the tough conversation, which was either, you know, hey, I'm going to let you go now while your income's hourly employee where you've got 50 hours a week year to date. I'm going to let you go now so you can get the most out of the unemployment packages that are being offered. You know, I'm sure there's going to be another, if not 2 or 3 other rounds. So yeah, the contract inspections are in, appraisals in, loan commitment is issued. We're supposed to be closing in 10 days and then, or 5 days. And then the due diligence that we as lenders are doing, which is, you know, verifying that employment yet again, you know, day of closing, day before closing. If they're not working, that's a deal that, you know, unless there's an alternative source of income coming into the deal, that's a deal that won't close.
I think at this point too, I think the question is also directing, you know, the perfect storm that happened for a few of us that were 2 or 3 weeks ago. We hedged a loan, which has been business as usual for the last whatever years. And then all of a sudden the investors in that loan to buy it backed out. So then therefore we had to find a home for it, even if we were under contract or even if we promised the lock. I can give reassurance from new business moving only, as far as all the parameters that Clint just named. Right. I would say with the new underwriting guidelines that all of these lenders, especially in this call, are coming out with now, will be able to close and fund your loan. The difference being is what we call neutral positioning compared to hedging. Is that correct, Ryan? Basically, we're doing best effort pricing at the moment right now. We're not promising a deal 30 days from now. We're going to promise it at the moment and get you closed. Is that correct?
Yeah, there's been a lot of different things that on the secondary side, changes that have been made to try to reduce our exposure for loans that may go away. The problem that you'll see and what we're seeing now is that the prices being offered are sort of out of the ballpark, right? So you know, a month ago on a 640 FICO, you know, 3.5 might have been the note rate. Now, even if it's available still on a best efforts lock, you know, the note rate's either got to be in the 4s or you're going to be taking a huge pricing hit or having to charge a borrower 2 or 3 points. So, you know, you just want to make sure that any of those loans that you have coming in, right? The best advice would be to get them locked with your company and investor, and make sure that documentation is in ahead of time. That way you do not have a long underwriting process, right? And so this is something that, Clint and I, we've talked about with the Mortgage Network team a lot, but changing the way that you look at and qualify borrowers. And if realtors, you have people that or may have had pre-approvals in the past, those pre-approvals may have been, in a time period with programs that do not exist anymore. So making sure that lenders that you're working with have all of the proper up-to-date information ahead of time, making sure you encourage your buyers to work with their real estate or to work with their mortgage professional. I mean, these guys even have some tools on the credit side to be able to help improve credit scores and at least provide some advice. Well, you may not be able to anymore give a borrower financing for a home because of their low FICO. You can give them a path forward. So I think all of those things are important.
I also want to touch on a little bit. Thank you, Brian. Brian, what are you doing? How are you talking to your real estate agents right now that your company works with and guiding through this market? Do you got a couple of bullet points that you can kind of help them, what they could be doing as far as with their borrowers and so forth?
Yeah, we're doing a lot of Zoom calls, and if we get together and do this as a group again, you guys remind me not to wear a t-shirt. I'm getting mercilessly roasted by my friends via text. But yeah, I mean, we're doing, this will be my 6th or 7th Zoom call this week with realtor groups. And it's important because we as leaders in our industry need to be out in front of our referral partners, educating them on potential pitfalls that they're going to deal with and how to best navigate that. To me, the number one talking point right now is realtors. If you're on this call, which it looks like we have almost 200 live watching. So I feel like you guys need to be very proactive with your communication when it comes to your mortgage professional. If you, like Ryan just mentioned, had a pre-approval that was issued a couple weeks ago, you need to be contacting the lender on that and making sure it's still good. If you're in a situation where you're a listing agent and you're accepting an offer on a house that is an FHA or VA or USDA loan, I would be calling that lender that issued the pre-approval and just confirming everything is still good. Beyond that, I mean, I want to be clear that my opinion is that the sky is not falling right now. And we're going to have some stuff to deal with when it comes to, the unemployment rate, going up, like John mentioned, through the roof for a short period of time. But I don't think we're in 08. I think this is going to be a short-lived kind of downturn. It'll be deep on the downside, but it's not going to extend out for years like it did in 2008. So I think our messaging to our database and our clients as realtors needs to be, hey guys, if you're a savvy buyer, this is going to transition into a buyer's market for you, and you need to be ready to pull the trigger because you might be able to get that same house at a little bit of a discount. And so if you focused only on listings for the last couple of years, you might need to consider a business shift into focusing on more buyer leads, because this is going to become a buyer's market.
Hey,
So
guys,
that leads, I'm sorry, Nathan, go ahead.
John, I just wanted to add, because I just texted y'all, and y'all are going to hear later today, apparently the governor is going to order non-essential businesses to close around state. And the reason why I wanted to share it now is because it just came across, but also because Brian mentioned, that sounds terrible and the media is going to start freaking out. But frankly, that's some of the stuff we should have been doing already. And I'll get off my soapbox here in a minute. But, the governor has already said, hey, don't be around more than 3 people or whatever. Well, the things that are non-essential are things like gyms, bowling alleys, stuff like that. Hopefully people weren't doing that anyway. But I share that to piggyback off what Brian said, is the sky is not falling just because of what you hear in the news. And again, let's go back. All of us on this call and the people that are dialed in and on this panel are essential to the economy. So it's still business as usual. We just have to be remembering, let's talk with our buyers. Let's talk with our sellers. Are they going to be employed? What do they know? How's it going? And let's responsibly work our way through that. I just wanted to share that before it broke out and everybody started panicking.
That's okay. No reason to panic. I did that last week.
Hey, John?
Yes.
I was just going to say, you kind of echo some of these comments, but what I wanted to focus on is there are similarities to 2008. That's why we keep all saying 2008, because in 2008 you had very swift loss of product, loss of liquidity, loss of funding, those kinds of things are similar. But as these other guys have talked about, I don't feel like we're in the same scenario. Mortgages didn't cause this problem. Mortgages are going to be part of the solution. I think one of the biggest challenges, that's the two questions that you brought up were, are we going to be able to close loans? Yes, we're closing loans today. We're closing loans this week. We're going to be closing loans next week and next month. So we're in the game, and we're going to be able to help pull this out. I think employment, as we continue to think about what are the biggest challenges, are going to be people, are they still employed at the time of closing? So I think that's the best thing, advice for us and for realtors as they're thinking about, is this going to be a difficult loan to get closed? It's just how solid is the employment? What are the opportunities that person might lose their job? And then if that's the case, it may be a situation where we have to push pause, and then they buy a house in June when it's all back, if that's when we're back going again. I don't know when that's going to be, but I don't think it's going to be 5 years like it was after 08. I think we're looking at a shorter term turnaround, and it may be in the best interest of all parties, if they lose their job right before closing, just to delay for a little bit and then still buy. So I don't think the sky is falling, and it's not 2008. But anyway, we're going to be here to take care of getting loans done.
And I think that's important, guys, and I appreciate you guys taking me out of the doom and gloom a little bit, because we do need to be a beacon of light. And I'm not talking about just the loan officers on this call or even the real estate agents that are watching. I mean, we all need to be able to work together in an environment like this. None of us on this call ever want to see the other guy falter and fail. We want to pull all of this together. That being said, we're talking about the future, and Charles Pulliam asked, any guesstimate on time frame where this back to pre-coronavirus environment, and will we see a different market even after secondary market is back from a lending standpoint, and best and worst case scenario from what economists are projecting? Those are tough questions. I'm not an economist, I'm a loan officer. But Ryan, I think you got a little bit of a kind of a say in that. I mean, can you give a best guess estimate on that for us?
If as I used to tell people, if I could predict rates, I would have been retired a long time ago. But I think some of the things that we talked about here are really important to note. One, this isn't a systemic credit failure like we had in 2008. I think most economists are talking about a deep but short recessionary period. We know that the rate and liquidity side is being taken care of by the Fed, and Ginnie Mae has actually put out a paper on, as of Sunday, that they're going to do some similar actions to try to take care of some liquidity positions. What that means is rates should remain where they should be, right? And so we're not going to see some crazy rate swings like we were seeing before. In terms of the credit characteristics, I think that might be something that we could see linger on a little bit further. If you just think about how that works its way through the economy, right now we're starting to put those clamps down because of a perceived default rate that has gone up now. If that perceived default rate is greater than what we think or less than what we think, that can adjust to how far those are going to be out there. But I think, even as the market starts to come back, it takes a little while for those defaults and people to get that were, taking some advantage of some of these forbearance plans or not paying their mortgage for, 30, 60, 90 days to sort of get back on track. So I think we'll see it's going to take a little bit longer to get that credit side back down to where we were, but it'll come back. And like you said, it's not going to be a 5-year thing. If we're sort of, through this by summer, this is going to be a 2020 contained thing. If we start to see this thing sort of stretch on, that's where we're going to start to have some issues, right? If all of a sudden we're looking at a 30%, increase in unemployment, from here, when it becomes 50, then that's where we'll start to see some things adjust.
Well, and I think to piggyback on that just a quick second too, in 2008, there was a slower peeling back of the risk. The aversion to risk crept into the market, and slowly but surely we started seeing product and program eliminated. And really, if I'm remembering it correctly, which I try to block out as much of it as I can, but it really wasn't until 2011 everything had been stripped back except for the right down the middle, high FICO conventional type deal. The risk, it took 2-3 years for it to truly get boiled down to where it was. So I think that on some level there might be a lesson being learned that has prompted what we've all felt the last couple of weeks, which is a very swift call to action, as opposed to going from 580 to then 600 to then 610 to then 620. It was this immediate shift, immediate risk off position, the non-QM stuff that had crept back in the market, et cetera. I mean, it felt overnight that all that stuff just dried up, disappeared. So I think that two things that come with that. One is I think it prevents it from being as deep and as long as 08 because we've shut it off. And I think that if anything, we've probably erred on the side of overshooting the runway a little bit because, you go from 280,000 initial jobless claims 2 weeks ago to 3.3 million initial jobless claims last week. And again, going back to the 7, 8, 9 conversations that I've had with people who were managing others or are business owners themselves, not only did they say they had to make the tough decision to get to send people home, but they also were very quick to say, and as soon as this shelter in place and this lockdown and the fear and et cetera is gone, we're bringing these people back in. So what's going to be interesting to me is somewhere between the best case as if nothing had happened and the 3.3 million initial jobless claims, somewhere in the middle is where the actual numbers are going to fall. So what you would probably see is, I don't know, June, July, maybe even August, some of those real numbers start working themselves out. You realize that, 3.3 people filed in March, but by June 1, 60% of those people were back at work. Well, then that means, maybe we overshot it with 660. So what you'll see is you'll probably see 640 as a pretty much across the board number. And then eventually as everything kind of gets filtered out, digested and settled, you'll see some of the appetite for risk coming back because we've all closed loans that even as low as a 600 FICO that deserved a home, that deserved the approval that we would get them and deserved the funding because there was some blip on the radar 3 years ago that gave them some issue, but they were 25% back ratio. They had 6 months reserves even after they came to the table. Those will come back at some point. And I think that to Ryan's point, I would be retired if I had the crystal ball as well. It's the time frame for when. And I think that's what we don't know is what's the digestion period for all this. And when it'll be easier to tell what that looks like timeline wise once there's a normalized, kids are back in school, people are going back to work, restaurants are now open. Once that happens, then I think you'll be able to put a little bit better timeline on things.
Absolutely, man. The key is getting the virus under control, right? I mean,
right.
Once that happens, the crystal ball becomes a little bit clearer, so we can start seeing an end in sight to when the non-essential work people have to remain home, that kind of stuff. I didn't mean to jump in, but I got a text that was a good question from a realtor. If the governor announces this, Nathan, like you said, are we as loan officers going to be considered essential or non-essential? Yeah. And I'll let you guys answer, but my initial response was, fortunately for us in our industry, we've got the technology that we can perform all of our job duties remotely anyway. So whether or not we're essential we're unaffected by that.
Yeah, and it's my understanding that we are at the industry, banks, finance, et cetera, are essential. Again, it goes back to when I said America is counting on us. Brian, you mentioned it. We can all work. Frankly, we can all work from home. Some of us do work from home, processors, all that kind of stuff, realtors as well. What this is doing is giving everybody a chance to, learn to do things differently, if you will, or reinvent yourself. A lot of agents that I've talked to, the houses that are listed, the owners don't want people just walking through and God knows, maybe bringing in the virus or something. So you see some virtual tours going on out there or some Facebook lives, the realtors just need to find a different way to do business, just like we're having to find a way to do business. We're in this together. I think that's obviously one of the reasons why we got on the call with John and everybody here. You know, we're competitors, but we all help with home ownership. And we were talking the other day, I think the #1 lender in town has 10% of the market share. That means 90% use somebody else. So there's many lenders around. Just like we're supporting small businesses now, support all the lenders you can. We, in return, any chance, y'all know, if a loan officer can find a referral for an agent, we're going to do that in a skinny minute because we know how valuable that is. We want y'all to, I don't want to speak for everybody, but I think I can on this. You've heard us talk a little bit about refinances and how a lot of people are taking advantage of that. We're all doing refinances, but it's the realtors' purchases that are the priorities at each of our companies and everybody around town, because we realize moving people into where they need to go, whether it be for jobs or whatever reason, is what's important to the economy. Sure, it's great that as loan officers, we can still make a living and help other people save money on their monthly mortgage payments, but the realtors need the buying and selling, and that's what the community needs. And so if you get a purchase contract, all of us on here are going to work our tail off to get that done. And we're going to be as honest and transparent and just like you need to do with your buyers, because we want to be a lender for life. You want to be the realtor for life. So that's why we do what we do.
And let's talk about the pivot stance, guys. Okay, so FHA got hurt a little bit. Pricing is off a little bit. VA, VA still probably, in my opinion, one of the better loans in the market and so forth. But there are loan products out there. This is the good news for the realtors. Fannie and Freddie have created great loan products, and a lot of times loan officers don't even take advantage of them, knowing that they can just go FHA because it's the one loan product where it's the 3.5% down payment. But what do you guys, as far as pivoting and moving things around? Because my Govy guidelines are a little bit tighter than right now my Fannie and conventional guidelines, and I'm clicking open my Home Possible loans, my Home Ready loans, and so forth. Kind of talk a little bit about what are some great products. I mean, we're funding loans and we're moving forward, and we're going to start closing on some houses. Let's talk about the good news for the real estate agents and what they can see. It's not doom and gloom. Get those buyers. What are some other things we can do for them?
Absolutely. Conventional is still going strong. That's one of the things that we were talking about earlier. I think you're seeing some of the FHA rules that are getting tightened up, getting more in line with conventional. So conventional is about 73% of my business anyway. So that's a lot of folks that are doing conventional financing already. But you've got as little as 3% down on a conventional product in many cases. It's case by case. It's a first time home buyer, that kind of thing. But 5%, it's only 1.5% more than the FHA. You can still get down payment through a gift for conventional. So there's a lot of flexibilities there that conventional has, especially if you then tie it in with the Home Ready and the Home Possible. So yeah, I'm in no way gloomy about that. I think we're still going to be financing houses. Agents are still going to be selling houses, and we're going to be taking care of South Carolinians. So I think there's still a lot of very positive news in the real estate finance world. Rates are still really low. They have been bouncing all over the place, but we're fussing because they go from 3 to 4.
That's great. It's a great point.
We're 8 1/4.
It's a great point though, because here's James Fleschman. He's been around since 2001 with Foundation, and he is a product expert. Every person on here is a product expert. And Michael Saxon asked the question, what's the difference between the local lender as opposed to the big box lenders? And I won't name names, but what's the difference? Well, the difference Clint Hammond's kind of a nerd when it comes to this stuff. He studies these guidelines and he knows the ins and outs to all this stuff. And I think all of us are a little bit. And if we're not the nerd, someone in our office is the nerd. And how do you structure this loan to help this qualified buyer get into the house? That's the big difference right there.
You just pinned it, John. I don't ever talk product without probably 2 or 3 conversations before I start talking product with either a borrower or a realtor. And that's why elimination of product or changing guidelines for various products in some ways it simply alters the pieces that I'm playing with. You can still sit down and put a strategy together. Every one of you guys on this call has done it for years. You know that you can sit down with somebody and you've got what? You got finite resources. You've got a defined amount of income coming in on a monthly basis, and you know what they've got going out. How can I take these pieces, put it together in a way that's going to benefit this client and put them in a house where they're comfortable? And putting a strategy together doesn't have anything to do with FHA or USDA or VA or conventional or pricing or secondary market. No, all of that stuff influences it. But at the end of the day, you're putting a strategy together to figure out what is the highest and best use of this individual's money in order to get them from point A to point B. It's really that simple. And all of us have the ability to do that. And none of us have lost the ability to do that in the last 2 weeks. We all still have the ability to do exactly what I just said, because we've got arrows in the quiver that will work and will get the job done. And if it's a situation where, yes, I'm so excited, we're going to get you into that new house that you wanted to buy, but you've got that 620, so we're going to get you into that house in 6 months after we do A, B, C, and D. So everybody still gets that yes. And it might be a yes, let's go shopping today. And it might be a yes, here's the plan, and then we'll go shopping. But at the end of the day, we still have the ability to do our job exactly the same way that we did before any of this started, period.
Awesome. That's awesome. And you know, guys, I kind of want to, it's been an hour, and I'm sure the attention span and people have got to get back to work, and so do the real estate agents need to get back to work. I want to kind of end it with all of us, all 5 of us here. I'm sorry, 6 of us, Ryan as well. You know, words of wisdom or a little bit of like, you know, encouragement right now, you know, because it's scary. But for me, I'll start off. The big thing I see the difference in right now, what we all kind of touched on a little bit, is all we need is for people to go back to work. But we can't right now. We're facing a pandemic, and it's scary. And you know, I think our leaders are doing the best that they can under something like this. We've never seen it before, but we need people to go back to work. And I think you'll see the mortgage market evening out. In the meantime, the real estate agents and the mortgage professionals, we're adapting. We're all adapting to make this work. It may be a little bit tougher. It might be a little bit more frustrating, but we're all here to help each other. So Brian, words of encouragement for our real estate community, man.
I mean, I think going back to what we talked about earlier, the messaging is, I mean, this too shall pass. We're going to be in it for a little while. We're blessed to be in a situation where we have the ability to work remotely for the most part. We're, as an industry, we have a lot of smart, resourceful people, like Clint said, that will be able to figure this out. And it's short term. It's going to pass. So stay the course, define your plan, call your database, generate leads, and sell houses. It's going to work.
I heard, I love that, and it will pass. Now, someone did say earlier, it might be like a kidney stone passing, but it's going to pass, you know, and once it's over, we'll get better. Nathan, sir.
Just echoing Brian's sentiments, I would remind people, don't look at this blessing as a curse. Again, a lot of people out there don't have a job, can't work from home, can't use social media to help other people in the community. As realtors, y'all can do all that. You're essential. You're allowed to work. You can use social media. You can virtual open houses. Lenders can still close. You know, from a political standpoint, we ought to be very thankful in this industry for the Realtors Association and the home builders and all the organizations that fight and lobby that work with the governor and things like that to put us in this position. So, you know, when I get off this call, it's business as usual, and just try to help everybody you can. People are hurting out there, but for those that are in a solid position, for those that can qualify to get a new house, there's no better time in history than right now where we are. So don't view this blessing as a curse.
Mr. Ryan Hayes.
For all of the realtors out there that are connected to one of these 5 professionals, right? You guys are lucky to have business partners like this. I touched on it before. It's not always like this. You've got a great group here, and nobody better to sort of usher you through this challenging time period. So I think, you know, in echoing the statements, we're going to see a return. The government has made it clear that they're going to do everything that they can to try to make this as smooth as possible coming out. And as Nathan said, lowest rates in history, We've got, before this little bump, the lowest unemployment rate in history. The economy was cruising along. So we're in a good position, and it's going to be in a good position. And you have, with these 5 here, the right people to help usher you guys through this and help you and your borrowers.
Thank you, man. Right, James Fleschman.
Well, I do want to say that I think there's still many, many positive things that are on the horizon. We've got to deal with the employment, and that is going to be a challenge. But I just am very excited about, we call realtors our referral partners, and then we are truly partners, and we've got to work together. We're going to help give them more information. They're also going to help us in navigating through all these different twists and turns, just like we're going to work with appraisers, just like we're working with underwriters and closers and paralegals and lawyers. It takes everybody to pull together, and there's going to be times when things bump and don't move as smoothly as they did in January, but we're going to make it all happen, and we're going to get through. We've got great rates. Keep coming back to you. And sometimes when I start fussing, these things have jumped up 0.5%.
God, rate spiked to 3.5.
So, we've got a lot of very positive things out there. Great product, great folks here in the community, and we're gonna continue to work on that. So I think it's going to snap back much quicker than people are anticipating, and we'll be back to the way we were prior to this.
Clint.
Yeah, I mean, 2008 made me an infinitely better loan officer. So, kind of like Nathan said, don't view this blessing as a curse. When it's hard for everybody. When things are difficult, it's difficult for everybody. So just outperform. And that goes for realtors and attorneys and appraisers, and for the guys on this call, and for the loan officers that we have with us on a daily basis. Separate yourself. And the way you do that is just, it's insanely simple. If you're taking care of your client, that's all that matters. And I can guide you through it. You help guide them through it. We'll guide each other through it. We got each other's back. And it's real simple. We can make a difference in both the short term by doing things the right way and helping people out that are in a bad spot. And we can do things to improve the situation for everybody long term as well, but just by continuing to do the good business that we already do. So, I'm not worried about it. Not even a little bit.
That's awesome, man. Thank you, guys. Guys, I know we all got to get back to work. It's 3:15. It's been on an hour and 15 minutes, and that is at least 1/12 of some of your guys' day. So thank you so much for doing this, and love and respect every single one of you guys. I call y'all friends, and I can't wait to see us on the other side, and hopefully we'll be able to get in an actual group and have a beer together. So, and the same with all you agents. We're going to blow it out big time one day, and thank you for everybody on this call. Brian, Prahl, Nathan, Ballentine, Ryan Hayes, James Fleschman, Clint Hammond. Thank you so much for Carl White and the Mortgage Marketing Animals, Nina, for setting this up on this panel, because we wouldn't have been able to do it without you guys. And
thank you, John.
No, I
Yeah,
appreciate
John,
it.
thanks for getting it done.
Hey, John,
man.
I was gonna mention it. If we get positive feedback on this, I'm sure everybody on here will be willing to do it again as information changes down the line.
Absolutely. We can do this again because information is going to change, and hopefully well, no, actually, Nathan, you said to be positive. In a few weeks, we're going to come out with better guidelines and back to normal, man. So thank you, guys. God bless you guys, and
Yep.
get back to work, and we'll talk soon.
Thanks, guys.
Bye-bye.
Thanks, John.
Bye-bye.